In this video, I am going to be teaching you whole life insurance in 10 minutes or less. Imagine a financial safety net that gets stronger every year, guarantees protection for life, and can save the day if unexpected expenses come knocking. That is whole life insurance. Meet Alex, a 35-year-old parent with a young family. Alex wants to make sure he can leave a legacy behind to his family of $250,000. He wants something to protect his family in case something happens before he's able to save up that money on his own. Make sure that they get that money no matter what. However, he is overwhelmed by the options. Term insurance is temporary, and investments are really risky. Enter whole life insurance. This is a lifelong solution for Alex. It has guaranteed death benefit, fixed premiums, and builds cash value over time. Alex purchases a $250,000 whole life policy to make sure that no matter what happens, he'll have a $250,000 nest egg to leave behind to his family. Even if there's an emergency that requires him to liquidate his savings when he gets older, he knows that his family will get that $250,000 no matter what. However, Alex runs into a little bit of a snag. 5 years into his policy, he faces an emergency. He needs to cover a medical expense for a loved one. But instead of panicking, Alex taps into his policy's cash value to cover the cost. Alex takes out a loan against the cash value to cover the cost of the emergency. Now Alex can pay back that loan over time at his own pace. Cash value is like a savings account that grows within his policy. As the cash value grows, there are a few other things Alex can do with the value that his program currently has. He could use the cash value to buy an extended term policy. This would use his cash value to buy a $250,000 term policy. The length of the term of that policy would depend on how much cash value was there at the time and how old he was when he decided to make that happen. He would no longer have to make payments on his policy, but the policy would eventually expire. Take, for example, he has $20,000 of cash value in his policy, and he decides to use all of that cash value in a non-forfeiture value. This is a non-forfeiture option. Alex would be able to take that $20,000 and purchase a $250,000 term policy for however long that much money would purchase the term for. At the end of the term, he no longer has coverage. Another thing Alex could do with his cash value is use it to buy a reduced whole life policy. This is called the reduced paid up non-forfeiture option. He would never have to make another payment on that policy again. This policy would also grow cash value and would be a permanent program at a reduced face amount. So we'll take that same example. Say he had a $20,000 value to his cash value. He could use that to buy however big of a whole life policy as a single premium whole life, and he would never have to make a payment on it again. The face amount would be smaller, but he would never have to make another payment. He could also fully surrender the policy for the amount of the cash value, which would end the policy. If his policy is participating through a mutual company, so if Alex has a participating whole life policy, he could receive dividends. Dividends are small profits that the insurance company gives back to Alex as a return of his premium. He can take these in cash, let the insurance company hold on to them and accumulate interest, use them to reduce his next premium payment, or even use them to purchase additional coverage, allowing his total benefit in cash value to increase even more. If Alex has his policy through a stock company, then his policy would be non-participating and he would not receive dividends. Remember, dividends are not guaranteed even if your policy is participating. They have to be declared by the company every year. Unlike term insurance, Alex's whole life would last forever. It's the foundation of Alex's financial plan. The cash value isn't just an emergency fund. It can be used in retirement, starting a business, or even buying a new home. Walt Disney actually started Disney with cash value from a whole life policy. So what's the difference between death benefit and cash value? Well, let me explain. Cash value is how much the policy is worth if Alex decides to give it up at that time and stop making payments on it. The death benefit is how much his beneficiaries will receive when he dies. At age 100, the cash value will equal the death benefit. The cash value grows every year up until age 100, at which point the policy matures. It's also known as the policy endowing, and Alex will receive a check for the cash value, which at that time will have equaled the $250,000 face amount of his policy. For your insurance exam, you want to remember that in a whole life policy, premiums can never change, Policies can be customizable with riders like accelerated benefit riders, accidental death riders, and riders to insure the children of the primary insured. A whole life policy can be a financial cornerstone to someone's overall financial plan. There are non-forfeiture options. These options are what Alex could do with the cash value at any time. And there are also death benefit options. Those are different ways that Alex's beneficiaries can opt to receive the death benefit when he passes. I hope this helped you guys understand whole life insurance in less than 10 minutes. Good luck on your insurance exam, and make sure to click the link in the description of the video for a free copy of my life insurance exam study guide.